Okay, this is our income statement. And again, what variables move with sales? Generally, all of our current assets, it'll specifically tell you in the problem, but it'll say something like cash, accounts receivable, inventory, and accounts payable are move with sales. So we'll say this one does, this one does, this one does, this one does. Fixed assets, known as lumpy assets, because generally they move in chunks. The key wording in the problem is, are they at full capacity or not? If they're at full capacity, that means they're working as much as they can to support their sales right now. If it says the company is at full capacity, it means fixed assets do move with sales. If it says they're at less than full capacity, they're at 80% capacity, then the calculation is more difficult, and we'll get into that in the next video. Notes payable may or may not, generally not. Long-term debt does not. Common stock does not. Retained earnings is going to go up by what we had over on the income statement, by what we had as additions to retained earnings from our new income statement. So let's continue with our process here, where we have our cash rising by 1.25. And I'm not going to write this every time, but you're just multiplying by 1.25 to get your new number. 31,000 is our new number for cash. 46,125 for accounts receivable. 110,500 for inventory, for 187,625. Fixed assets, in this case, moving with sales, so you're just multiplying by 1.25 to get 450,000. Add those up and you'll get 637,625 for our new total fixed assets, given our budget of a 25% rise in sales. Accounts payable, they are moving with sales, so they're going to rise to 60,000. Notes payable doesn't say anything about it, so we're going to assume it's unchanged. Sits at 18,000. Long-term debt also doesn't say anything about it, or says it's unchanged, so we'll leave it at 120. Common stock also 120. We're going to add to retained earnings whatever we added from the income statement. If you go back and look on our income statement, we had, I have to look myself, 53,437. So plus our 53,437, and our new retained earnings will be 257,537. And our total liabilities and owner's equity then is going to be 575,537. And you'll notice that we don't balance. And that's our problem is, and that's why we're going through this process, is what's going to happen to our assets given a 25% rise in sales? Well, they're going to go up to 637. What happens to our liabilities? They only go up to 575, which means our assets have to go up, and we have to get that money from somewhere. Either it's coming from retained earnings, or we're going to have to borrow more money, but we don't have enough money to support this rise in assets in order to support our sales. And that's what you're calculating here. What is the external financing needed, which is just your assets minus your liabilities plus owner's equity. How much does your balance sheet not balance? So in this case, 637,625 minus our 575, 537 to get 62,088. We need to get 62,088 bucks in order to support those assets from somewhere. Either we're going to take on more debt, and we put it there. We could change the amount that we're retaining. We retained 70%, maybe we retain the whole thing to fund some of the increase in the assets, but it has to come from somewhere. Now, can it be negative? Could your liabilities go up more than your assets? It can happen. It would probably suggest that you're not at full capacity, so you had no increase in fixed sales, and it just means you have extra money that you need to pay out, or you would end up dumping it in the cash account. Okay, so the next we'll talk about what happens if we're not at full capacity.